Low Uzi Vert, to be exact. And I'm not from Earth, I'm from outer space. Whoa, that's different. I'm somewhere I'm not supposed to be. Yeah, I remember she didn't notice me. Yeah. Why I'm tripping, she ain't old as me. Poor man, not even cold as me. Every time I have a show, got sell it off, I grow to sleep. We got some new bands, we got some new bands, yeah. We got some new bands, we got some new bands, yeah.
Alrighty, what is up, Astro Trading? How's it going, boys? Today I'm going to give you a quick crash course on what I've learned about trading options. And I'm not going to get into the technicalities of why things work. I'm only going to give a surface level, simple explanation so that you guys can begin trading right after this. So without further ado, let's get into it. When you buy an option, essentially you're betting on whether or not the price of a stock is going up or down. When you buy an option, the thing you are purchasing is called a contract. If you think the price is going to go up, you purchase a call, and if you think the price is going to go down, you buy a put. Now I'm going to be using Robinhood's interface because it's simple and it's good for flexing on Instagram. Before choosing a contract, you want to find an expiration date about a week to 2 weeks out from now. What this means is that each day the value of your contract will decay, and I'll tell you where you can find how much it decays a little later, but essentially you want to buy a contract with an expiration date that's far out so that if you do end up losing money that day, there's still time for the price to change and for you to recoup your losses and make a profit. That being said, the value of the contract decays each day, and once it reaches the expiration date, it expires worthless. When looking for a contract you can afford, typically I suggest looking for a price that is 15 to 25% of your portfolio. When scrolling, you can see this bar here, and it says the stock's current price. For calls, when you think the price will go up, anything below this line is called in the money. And you can make a lot more money buying contracts that are in the money, but they will typically be more expensive. Now, contracts above this line are called out the money, and these are always more affordable, but give lower returns. When buying puts or when you think the price will go down, this is reversed. Contracts above the line are now in the money, and contracts below the line are now out the money. When looking through contracts, you're looking for a price that you believe the stock will reach. Now, you can still sell for a profit even if it doesn't reach this price. Keep that in mind. And the important thing is that you chose the right direction that the price will go in. When you look on the right here, we can see these really cheap prices in comparison to the stock's actual price. Now, this is not the actual price of the contract, okay? You need to move the decimal 2 places to the right. That is the actual contract price. The reason for this is because this contract is allowing you to buy 100 shares of this stock at this price. So the price you're seeing here, just multiply that by 100 or just move the decimal, you know what I mean? So this is as far as I'm gonna go into explaining the technical side. If you want to learn more, you can watch other YouTube videos that will give a much better explanation than I can, but I'm not really here to dig into the technicalities. I'm just trying to teach you how to trade, all right? So let's run through this process. I think that this company's stock will go down soon because of Corona, so I'm going to buy a put. I'm going to select an expiration date around a week or 2 weeks out from now that is priced within 15 to 25% of my portfolio value. And I'll find the contract that is out the money, and before purchasing this, I'm going to check the Greeks. So the Greeks are just a detail description regarding your contract. So I'll point out the only two of the Greeks that you need to know. The delta, which tells you how much the value of your contract will increase with each dollar the stock price goes up. And then we have the theta, which tells you how much the contract will decay with each coming day. Now that we have it here in our portfolio, many people who are new to this don't really understand this concept. Your contract's value will fluctuate like a stock price. The value of your contract is what's moving up and down. Obviously, when you think the stock price has risen or fallen as much as it will, you can exit and secure your profits. If not, you're always good to hold and sell at a later date. Just avoid holding too long or the decay will catch up to you and bite you in the ass. So here are a few lessons I've learned over my days trading. So if I post a play ever and you're involved in the trade group and a decent amount of time has passed, do not feel like you have to buy into it. If the price has changed a significant amount, don't buy into it. Do not get FOMO. There's always other plays to come. You can just take a day off. It's not that deep, all right? So just never get FOMO. Never impulse sell to cut losses. So say you just bought a couple minutes ago and you see that the price is plummeting and then you're just like, oh, and then you sell. and then you're just negative. If you would have just waited maybe 20 minutes, the price could have easily rebounded. So never, ever, ever impulse sell. Like, use logic. You need to remove emotion from trading, and do not think about the amount of money that you're potentially losing like at that moment, because the only time you actually lose is when you close and you put out a sell order. All right, do not impulse sell. That is probably one of the most important things you can do, even if you're just trading regular stocks, options, like sports betting. I don't know, you do not impulse sell. All right, and remember that everyone has red days. It isn't going to be a dub every single play. Keep this in mind. When I began trading, my portfolio went from $2,000 to zero in a single day because I was inexperienced. So I am here to teach you guys and give you lessons so that that doesn't happen to you. All right. And the number one rule, the most important thing, you can apply this to everything in your life. All right, especially trading options. Trust your gut. Okay, if you feel like you're going to buy into something and it isn't going to pan out, don't buy in. It's better to just stay positive, like your portfolio value or mentally, whatever, and not buy into something and lose than it is to just miss out on potential profit. All right, just it's better to sit out. If your gut's telling you no, don't buy in. You know what I mean? So trust your gut. All right, guys, be active in the Discord. The link is in the description. Check us out, Astro Trading. We're on the come up. We're here to kick SMD Trading's ass 100%. All right, we're coming for you. And yeah, just keep your eyes peeled, boys. I'll be posting plays. Staff will be posting plays. Yeah, that's my crash course on how to trade options. Thank you for watching.
I can make a gay girl turn to a straight. Take off them G's and put on a leg. Fuck all of that. Take your bitch and I grab on the waist.